Great. All right. I think we're going to go ahead and get started now. Thank you, everyone, for joining us. Welcome to the first ever ETF Portfolio Partners webinar series. The plan is to continue providing you content through our normal channels, right? We're going to continue to be doing those monthly and quarterly updates, but we wanted to provide a new system as well. And so through this webinar series, the plan is to continue doing these. I know Will has a financial planning series he'll be planning later that we'll send more news on as well. But today I'm going to be covering economic and stock market developments throughout the first half of 2024. I promise to keep this brief. It's going to be about 20 minutes. So let's go ahead and get started. So what I'm going to be covering today, the key topics, first, we're going to look at asset class performance. I'm going to discuss how US and international markets have performed through the first half of the year. And then I'm also going to be touching on the fixed income market. Then we're going to turn to the US economy. We're going to give a brief detail on some trends we see going forward, what's going on with inflation, as well as current Fed policy. From there, we're going to discuss portfolio allocation, portfolio structure, as well as what we see driving our portfolios in the near term. And then finally, we're going to be discussing the 2024 presidential election, right? Politics and markets often dance together, so it's important to review current political events so we can see how they could impact our investment climate. So let's go ahead and get started. Performance. So the S&P 500 had a really, really good start to the year. It was up 15% over the first half of 2024. The tech-heavy NASDAQ index was actually outperforming compared to the S&P, up 18%. And so what I will say is that, right, these are returns that are slightly abnormal. In any given year throughout history, you would expect the S&P to be up 8 to 9%. And for us to already eclipse that and double it says a lot about where we are right now in terms of our investments. So what's been driving the US stock market higher? First, we're going to look at US growth. Mega cap and large cap companies have performed exceedingly well throughout the first 6 months, mainly due to one thing: AI, artificial intelligence. Investors have put tons of money behind AI companies such as Apple, Microsoft, NVIDIA, to name a few, and they've just received a lot of tailwinds right now with the investments. And it makes sense, right? A lot of people think AI is going to lead us into this new age economy, and as such, investors are very hopeful and they're putting funds in right now. And so the first half of the year was very much so dominated by large cap growth, but large cap in general continues to be the place to be for equities. If we look at value-based companies, again, large cap and mega cap both outperforming their small and mid cap counterparts. And again, very healthy returns over the last 6 months. Mega cap value is up close to 10%, with large cap up almost 6%. Again, these are halfway point numbers, so it is good to see. However, with that being said, right, there is a very good chance we could see some volatility, as we've already seen this last week, and have a little bit of a mean reversion to get back to that long-term average. And while I do think we're going to end the year on a positive note, it is to be said that we've had a really good first half of the year. So things could get a little bumpy here for a while. Looking at international equity, it's been really nice to see Europe. Europe's been very resilient over the first half of the year. They've held up really well. As you can see, they're up almost 7%. I've included France on here because this is what's been driving down Europe recently. France has gone into some political uncertainties, and as such, they've gone through a correction. Also, France is a very large stock market, so it makes sense to see the France underperformance driving down the rest of Europe, but still Europe up close to 6% over the halfway point. Very encouraging. China, right? China has been underperforming for quite some time now. They're kind of going through regulatory and financial housing issues. They're especially in their corporate real estate. They're going through very similar to a 2008 type global financial crisis that we had in the US with their real estate. As such, mainland China, as you can see, down almost 1.6%. And then Hong Kong, kind of the financial capital of China, down 12.4%. And so this will be a story that will continue to play out through the remainder of the year. If China can recover, what they're going to do, their central bank policies to help them get out of their recession right now. Another interesting thing I want to point out is India. A few years ago, India became the most populous country in the world. As such, they've put a lot of investments into research and infrastructure development, and they're starting to catch up in terms of economic growth and getting to that global platform that you would expect to see with a country that big. So we expect to see India continue this trend moving forward. It will be interesting to see where they stand at the end of the year and then thereafter. Fixed income, right, otherwise known as bonds, have continued to struggle during the first half of the year. The total bond market was down 1.4%, following long-term bonds down even further at negative 5%. It's without a question been a very tough time for bond investors. It's been very frustrating. Over the last 3 years, bonds have been in a bear market. However, a lot of economists, investment analysts, and ourselves believe bonds will provide above average returns here in the future as we start to see the level of interest rates slowly decrease. Another reason why you can't give up on bonds is because of their diversification benefit, right? You never want a portfolio with all similar holdings that move in tandem together, but rather you want holdings that move up and down at different times. With that being said, bonds still provide an extremely good diversification factor to a portfolio. While we didn't see it over the last 3 years because interest rates were coming up, bonds do have the ability to cushion some of a portfolio's return blow when markets start to correct. And so that's why, in terms of diversification, you always want to have some portion of this asset class in your portfolio. Now we're going to turn to the economy, and here's just a brief scorecard of things that have gone on. Starting off with GDP or economic growth, right? How much has the US economy expanded over the last 6 months? And surprisingly to some, it's actually grown over 3.2%. Very similar to the stock market here, this is a growth rate that you would expect on an annual basis. So for us to already have this kind of economic expansion over the first 6 months of the year, very encouraging. However, with that comes some other factors we have to look into as well. Unemployment, right? The labor market is weakening. That's a fact. If you look at from January to June, unemployment's increased 11%. We now sit at unemployment of 4.1%. That's going to be something that the Fed is going to continue to monitor throughout the remainder of the year. You also look at things like consumer demand. Those have begun to weaken as well, as something like credit cards, right? Consumer debt is starting to add up as well. So again, some underlying currents that we have to monitor, and that the Fed is going to be closely monitoring and discussing at their upcoming meetings. Now, looking at inflation, right? Inflation's been on the mind of investors for quite some time now. That's why the Fed has been in this interest rate hiking period to battle inflation. So it is positive to see a decrease in inflation over the last 6 months. Inflation's come down 12%. We're now at 2.9% for overall inflation. Even more interesting, we look at this figure called core PCE. PCE just stands for personal consumption expenditures. Think of it as necessary household items for individuals to live: food, clothing, toilet papers, things like that. The word core in front of it simply means that this measure is excluding more variable items such as food and energy in order to gauge what Americans are spending money on and the price level without those more variable items. And Jerome Powell, the Fed, has actually come out and said this is their preferred metric for looking at how inflation is doing, and they monitor this even more closely than just the normal inflation rate. So to see that decrease of 19% over the last 6 months to now sitting at 2.6% means we're going in the right direction. So what I have on the screen now is something called an economic cycle. Every country has one. Every country is always at a different period. But as you can see, if we start at the end here and in the recessionary period, we can then turn all the way back and look at the stages of economic growth. So we have early, mid, and late expansion phases of an economy, followed by a recession. The word recession tends to scare people. Recessions are very, very normal. They happen on average every 5 to 10 years. Again, it's part of this cycle that we always continue. And by all means, when you look at, right, we still have growing GDP. Our economy is still expanding, yet there are some pressures in the labor market with unemployment increasing, and even the decreasing in inflation leads us to believe, as well as economists, that we are in the late phases of an expansion, which means, right, next on the economic cycle would be recession. And so while we haven't seen it yet, do expect to see some more recessionary pressures later into the second half of the year. And right as such, we could see some interest rates, beginning to come down. And there's about 8 Fed meetings between now and next year. Currently, economists are forecasting around 6 rate cuts from those time periods, leading us to believe, number one, the Fed sees a recession in the near term, and number two, that the level of interest rates will come down more to that long-term average of around 3.5 to 4.5%. So what have we been doing in the portfolio? Regarding stocks, what we've done recently is we've shifted away from growth companies to value companies, and then we've continued to underweight our international equity exposure. On the bond or fixed income side, what we've done is we've increased our maturity in anticipation of rates coming down from this level, simply because, right, bonds act as a seesaw effect. When interest rates are going down, the return and price of bonds gets shifted up. The longer maturity bonds you have in your portfolio, the higher the return. And so we wanted to essentially capture that movement should rates come down. So here is a brief snapshot of our equity holdings. As you can see, the transition from growth to value was made. We now hold roughly 38% of our large cap exposure in value compared to 30% in growth. Internationally, we still have most of our exposure in Europe, and then led by the Pacific. You can think of this as like the Japanese market, and then finally emerging markets at a quarter. This would be China and India. And with that being said, we still are underweighting international equities. We only hold about 8% of our equity in foreign companies. And if you were to just kind of pull the entire average portfolio of an American, what you would tend to see is 15 to 20% in international equity. So, right, therefore, we are underweighting it. The reason being, over the last decade, international equities have just consistently underperformed domestic equities, US equities. So as long as this performance is justifiable for us to own US equities and underweight international, we will continue to do so as we see in the future. On fixed income here, again, we can see the shift from just core midterm bond allocation to our long-term bond allocation has been made. We currently have roughly 40% in long-term bonds, 50% or just an average weighting in medium-term bonds, and then underweighting short-term bonds, again, in anticipation of rate cuts there in the future. So as I mentioned, right, we shifted from growth-based companies to value-based companies. The primary reason we did this, again, is because of where we are in the economic cycle. And so what this chart shows on my left, it's from Fidelity Investments. It's really interesting. It shows each stage of the economic cycle, as you can see, early, mid, late, and recession. And then it shows different sectors of the market and how they perform during each stage. And as you can see, since we are in a late expansionary period headed towards possible recessionary times, sectors such as consumer staples, healthcare, utilities, value-based companies tend to do better than growth. Another reason we think a rotation is happening and why we moved from growth to value, as you saw on the first slide, growth has just had an amazing start to the year. That's a start that likely can't continue. You would expect to see some investors getting out, taking gains, moving away from growth. So for those two factors, that's mainly why we shifted away from growth into value-based companies. So to end the presentation, I wanted to talk about the 2024 election. Obviously, it's on everyone's minds right now. And so I'm just going to go over some brief points and we'll go from there. So really, this isn't more of a topic for the election, just kind of news on what's going on. So there's been a lot of volatility this week. The NASDAQ, the growth component of the market, is down roughly 5%. The S&P was down at a point over 2%. This is because, in our opinion, since Biden dropped out of the race and VP Harris has become the presumptive nominee, the market has more unknown factors, right? And you have to remember the stock market is always trying to value itself in the future. And when you have two known quantities, such as former President Trump and President Biden, they're very much known quantities in the market. People understand their economic policy, they understand the cabinet positions they're going to place. And when you take one of those known quantities out and you add an unknown, such as VP Harris, it creates uncertainty. The market doesn't like uncertainty, so it's only normal for the market to react and try to reprice or revalue the future. And so that leads to volatility. And so for that reason, we expect the volatility to continue in the near term, but it should level out as we get closer to the election and people are more aware of what VP Harris's stances are in terms of the economy and the stock market. So the the three main points we're looking at for the election in terms of the stock market and the economy. Number one, taxes. The Tax Cuts and Jobs Act of 2017 has a lot of parts expiring in 2025. This is a big deal because the main part expiring is the corporate tax rate. So Trump signed into office in 2017 the Tax Act, which essentially slashed corporate taxes from 25% to 21%. So should he become president again, we would expect Trump to, advance or continue to use that same tax policy. However, should VP Harris win the White House over, you would expect her to put her own stamp on taxes, repeal this act, and as such, it would only be natural to see volatility in the stock market as corporations try to manage this new tax landscape of higher taxes. Energy is going to play a huge role in this election and the elections to follow. It's just a fact. President Trump has made it very clear that he does not want to rely on foreign-based energy. He's made promises to bring energy production back into the United States. So you would expect to see domestic energy companies prosper under a Trump administration. Compared in contrast to VP Harris, if she was elected, she does have plans for clean climate energy, green energy. And while we're nowhere near the capacity or capability of powering our entire power grid with clean energy right now, VP Harris would likely add regulations and restrictions to domestic energy companies, which could subdue their performance during her administration. And then finally, inflation. Inflation it's just such a good topic for politicians, especially right now, because it kind of drives home two different points. Number one, what I can do for the economy, and number two, how I can help Americans, right? Every American has felt inflation over the last 3 years. And so inflation is going to be one of those key talking points. Expect each candidate to explain how they're going to solve inflation and how the other candidate can't solve it. So really, taxes, energy, and inflation, well, those are the three things that we see, driving the economic landscape for the presidential election. And I wanted to wrap up this presentation by going over what I think is a really interesting slide. This is from White Charts. And what they've done is they've put out data since 1950 on the S&P 500's price performance for each year that there was an election, all years together, and then non-election years. And what's really interesting to see, right, is that during election years, the S&P 500 was up 83% of the time. This is compared to all years where the S&P was up 72% of the time, and non-election years, the S&P was up only 68% of the time. So a couple interesting things here. Number one, for on average, the S&P is up more than it's down. Number two, while it may seem like the market is going to go down based on who wins the presidency, that just statistically isn't true. So what I like to tell investors is that rather than, using knee-jerk reactions to manage your portfolio, let statistics, let history be your guide, remain a long-term investor and stay disciplined towards your long-term strategy. That's the best way to do it. And again, just avoid those reactions at all costs. So in closing, again, we feel really good about where the market is right now. The S&P had a great start to the year. However, economic data, while we are still growing as an economy, we're beginning to see some pressures underneath, particularly the labor market. Interest rates, should we come into a recession, would be expected to be pushed down. That would help increase bond returns and also value-based companies. And for that reason as well, value stocks are relatively attractive to growth stocks right now. That's why we made that shift. And then finally, the election is such a short-term event where us as investors are very long-term in nature. We have very long-term time horizons. So don't let them get in the way of your long-term goals. So thank you for joining me in our first ever webinar. Hopefully it went well. I'll go talk to everyone out there afterwards and we'll see. But let us know if you have any questions or comments, or if you want to receive this slide deck, we're happy to send it out. So with that, I'm going to go ahead and end this meeting. Thanks, everyone. Have a great weekend and be well.